Hello and welcome to our channel. The whole world is watching as Bitcoin and other cryptocurrencies continue to break new records. The IRS is watching too. If you own Bitcoin or Ethereum, you need to understand how cryptocurrency affects your tax liability every time you buy, sell, or mine it. Watch this video to the very end so you don't miss the most important thing.
Did you know? Most Bitcoin exchange transactions occur not for dollars, for yuan. Cryptocurrency is a type of virtual currency that uses blockchain cryptography to secure transactions. It also has no central bank controlling the supply of currency available on the market. Unlike centralized electronic money or traditional paper money systems called fiat currencies, cryptocurrencies rely on distributed digital registries to protect and verify transactions. This blockchain technology anonymously records every transaction ever recorded and acts as a constantly updated checkbook available to all. There are many different types of cryptocurrency, but Bitcoin is the best known, followed by coins including Ethereum and even Dogecoin. There are also ways to get cryptocurrency beyond simply buying it on an exchange. For example, some cryptocurrencies use mining as the process of solving complex equations to write data into a chain of blocks. To encourage miners to participate, they can get paid in new crypto tokens. You can also get cryptocurrency through a marketing promotion on an exchange or through a giveaway.
Many people immediately point out that cryptocurrency is not backed by any government and thus is subject to less regulation than fiat currencies such as the dollar or euro. This lack of oversight has led many to believe that cryptocurrency investors engage in elusive and anonymous transactions that allow them to evade taxes. However, this belief is completely false.
In the United States, cryptocurrency exchanges must report users' profits and losses to the IRS, and cryptocurrency is taxed the same way as traditional stocks or similar assets. Cryptocurrency is considered property for federal income tax purposes, which means that the IRS treats it as a capital asset. It means that the taxes you pay on cryptocurrency are the same as the taxes you may pay when you make a gain or loss on the sale or exchange of a capital asset. For example, when you buy a capital asset, whether it's a stock, bond, exchange-traded fund, house, bitcoins, or any other investment, you initiate a basis equal to your cost to acquire it. When it comes time to sell your underlying asset, you simply compare the net sales proceeds to your original basis to determine if you have a loss or capital gain. If the proceeds exceed your original cost, you get a capital gain. If you cancel, you have recorded a capital loss.
When you buy and sell cryptocurrency, comparing your net proceeds to your costs is not the only step to determine how much you owe in cryptocurrency taxes. You also need to consider the length of time you held the asset, as that determines what type of capital gain or loss you recognize. Depending on how long you hold your cryptocurrency, your gains or losses will be considered short-term or long-term. This distinction will play a big role in how much you have to pay in taxes on cryptocurrency.
Short-term gains and losses. When you buy and sell an asset within 365 days, you recognize either a short-term capital gain if it was sold for money that you paid for it, or a short-term capital loss if it was sold for less than you paid for it. Short-term gains and losses are taxed as the same tax rates as you pay on ordinary income, such as wages, salaries, commissions, and other earned income. The IRS has 7 tax categories for ordinary income ranging from 10% to 37% in 2021. Long-term gains and losses. If you buy an asset and sell it a year later, the resulting difference between your net sales proceeds and your basis represents a long-term capital gain or loss. Generally, you will pay less tax on long-term gains than you will on short-term gains because the rates are usually lower. There are currently 3 tax rates on long-term capital gains: 0, 15, and 20%. The rate you pay depends on your income. You can also offset offset capital gains with capital losses. However, the offset must first be applied to gains and losses of the same type.
The complicating factor for crypto investors arises when they try to use their virtual currency to pay for goods and services. The IRS decided to treat cryptocurrency as property in 2014 because at the time most people considered it a capital asset. Now that more and more companies are choosing to accept cryptocurrency as a form of payment and people are beginning to accept it as a unit of account, many people have begun to see it as a viable alternative currency. However, the current tax regime for cryptocurrency prevents the wholesale substitution of fiat currency.
Using traditional fiat currencies, you simply pay for your purchase and have no tax implications related to the value base or value of your currency at the time of payment. However, cryptocurrency users must deal with capital gains and losses in addition to any sales taxes they may face at the point of sale. For example, imagine you bought $10 worth of Bitcoin 2 years ago and it has since risen in value to $100. If you sell it on the exchange, you would have $90 in realized long-term capital gains, just like with any other capital asset. If you instead use the same $100 Bitcoin to buy groceries at the supermarket, you would still have to pay taxes on the long-term capital gains on the $90 difference between the appraised value and your cost base. As you can imagine, keeping track of capital gains and losses for such everyday transactions can be tedious and a clear obstacle to completely replacing fiat currency.
Exchanging cryptocurrency also exposes investors to taxes. You are effectively selling Bitcoin if you buy Ethereum along with it. So you need to report the difference in the price of Bitcoin between when you bought it and when you spent it on Ethereum, and know the price on Ethereum at the time you bought it, when you sell it later.
Many exchanges help crypto traders systemize all this information by offering free exports of all trading data that an accountant can use to determine their tax burden. Blockchain solutions are also good for recording these data and highlighting relevant tax points of interest. Platforms such as TrustVerse have smart contract asset management services that arrange for the digital identification of an individual and their assets in blockchain to ensure that tax and inheritance liabilities are handled with consistent accuracy according to the asset owner. It is always advisable to contact a certified public accountant the first time you attempt to file a tax return for cryptocurrency. While it may seem difficult to engage in a multi-year trading career, it must be done, and it's getting easier as CPAs and other tax professionals learn more about crypto assets. For now, the IRS is letting people get used to the new way of doing business and has published guidance on amending old tax returns to include cryptocurrency. Experienced traders have already fulfilled their commitments and are now focusing on the cryptocurrency market next year, without this cloud of uncertainty over their heads.
Thank you for watching this video. Check out the channel for more videos.